So some of the email questions that we came in related to this tool and a little bit to the portfolio. Don had asked, how can I see the expected put value out in time if I open a married put position on Verizon? Earlier today, Pablo sent me an email, says I was looking for a help video on the profit and loss chart tool. I need insight into the red and blue line and why the calculate expected profit and loss has nothing to do with the blue line. We sort of just looked at that for Jerry, but we didn't explain the insides of it. We're going to do that right now. And then related to sort of that question, Paul earlier this week had shares of Peloton. He wanted to know if he should sell at or out of the money calls on the position to lower the cost basis, or if he's concerned, should he do a married put and then sell calls against it. And I had to give him a warning, similar to what I just talked about not selling a call below the put strike price. But let's take a look at Don, Pablo, and Paul. And I think we'll start with Pablo first. That makes the most sense. So let's go back to PowerOptions very quickly. And instead of being here in the profit and loss chart where we were, we're going to go to the portfolios. And there's the three positions we were talking about. Pablo has one of these interesting structures. I forget the name of it. I know that I think it's a Tasty Trade one that they have a specific name they like to use. It can be a useful strategy. It does require some margin to do this trade. But what it is essentially he's bought a June 3,800 put, sold an out of the money, lower strike, 3,750 put for about 93.55, and sold a lower strike, 35.50 put for $41. Now, this is essentially a bear put debit spread with an extra naked put position. So only one of these two sold puts has to have the margin requirement, but the margin requirement, of course, is pretty high in those cases because of the strikes that we're talking about. So let's go to the profit and loss chart. And this is that structure that we are looking at. The max return is in this plateau range between the lower strike sold put, 35.50, and the higher strike sold put. If the stock is between these two ranges, what happens? Well, essentially, this is a bear put debit spread. Selling that 137.50 and buying the 3,800. When the stock's trading below 37.50, what happens, of course, is we get assigned at the 37.50 strike, but we have the right to force someone to buy those shares that we were forced to buy due to the obligation of the short put at 3,800. We close out the spread, and we'd get the 50 points back from the debit spread, and the 35.50 put that we sold expires worthless. So max profit on the bear put debit spread side, max profit on the cash secured naked put, that's your max profit level. Selling this extra put means that this debit spread we were just looking at here is actually done the whole position at a credit. So even if this SPX, stays in this range, all three puts expire worthless and you keep the net credit. The break even is down to 34.78, a pretty big drop down here in this level. So it has a wide range of profit, max profit in a 250 point window, still strong profit up to 3,800, and the full credit profit only without the benefit of the debit spread, the extra gain on the long put position. But Pablo's questions were 3 points related. One, what is this blue line? The blue line is the profit and loss of the position at expiration on June 17th. If the stock is here, that's the profit that you would make. And it's in this plateau here because you make the full profit here and the full profit on the debit spread. Why do you start to lose down here? As we start going into the red in this area at expiration, and it's because the value to buy to close that sold put at 35.50 is now higher than the benefit of the debit. That's when we start to lose. And at expiration, if the stock is above your put strike price, all three put strike prices, what happens? All three puts expire worthless, and you just keep that initial net credit, and the margin is cleared off of your account. So that is a pretty big margin that I mentioned at 375,000, for this trade. the red line. The red line is the profit and loss, and the values monetarily are shown over here on the left at the halfway point, halfway between today, May 20th, if I open this position, and June 6th expiration. I'm sorry, June 17th expiration. June 6th is halfway between those two positions. So that's why this curved red line is here, showing your expectations of profit points halfway between now and expiration. Why is it curved this way? Why isn't it closer to the full expiration? Because the tool is using the Black-Scholes pricing models to estimate what these options would be worth on any trading day between now and expiration. The default is the halfway point right here, our curved red line. The reason why it's not at full profit is because there's still time value remaining on all three of these options. The max profit of positions, if you get the max profit, occurs when all the time value is out of all of the options at that moment of expiration. You'd still have to pay money. Even if the stock was up here at $37.50, you're going to have to pay money to close out your $35.50 put, the $37.50 put, and that cost is going to take away even from the value of the $3,800 put that you bought. So you're not going to be near full profit in that case. But we can see that, of course. We scroll down below, and we have the field here for calculate. So let's say what would happen if the stock was at $37.50 just 5 days before expiration on June 13th. Okay, now remember, our maximum profit was $7,175 at expiration, $2,175 here. Pablo's other question is, how come when I make a change to the calculate field, it doesn't change the blue line? Because the blue line is only at expiration. That doesn't change. With the prices that you entered, if you hold it all the way to expiration, that's what the profit and loss is going to be. What changed when I did that is the curved red line. See how it's now closer to the maximum profit because we're closer to expiration, and the stock's at $37.50. Of course, I hover over it, and it shows me here what my profit would be at expiration versus what my profit would be at the time I selected between now and expiration, Pablo. Okay, the red line changes when you use the calculate feature. The blue line is always the same unless you change the prices on the upper entry level here to different values. Then the blue line would change. But we're not changing the prices. The blue line's just at expiration when all time value is gone. What would the gain and loss be at those times with those stock prices? The curved red line is initially the halfway point to give you a gauge of what you might expect. But you can run your what if scenarios down here. The red line is changed on the graph when you use the calculate feature, not the blue, and it does show you the monetary expectation. With only 4 days to go, I'm not at maximum profit yet because there's still expected time value remaining on our two sold options that we would have to buy back, negating the value that we have that's also declining at a loss towards us. I mean, we're making a profit on these two, don't get me wrong, the two short legs, but it's not at zero because we're not full at expiration at this point. So Pablo, I hope you get a chance to take a look at this and review that and see, in addition to what I talked to you earlier today, how that works for you, how this works in conjunction. As always, if you have other questions about it, you give me a call and let me know. Now for Don. We just sort of saw that a little bit, but Don had a question. How can I see the expected put value out in time if I open a married put position on Verizon? Well, entered Don's question in, position, 100 shares of Verizon at $49.36, and at the time, the 18th of November, 55 put at $7.08. Going once again now to the profit and loss chart. And Don, if you didn't enter it in the portfolio, remember you can just come to the custom spread tool, type in VZ, put in the security that you bought 100 shares, and then go in and select the option that you want and build the position on the fly. But here's our Verizon position with the stock at $49.36, the 18th of November, 55 put for $7.08, total cost basis of $56.44, maximum risk of $144 or 2.6%. And he wanted to know, if I think the stock's going to hit 55, say in August, how can I expect to see what my profit on the position would be or my value on the put? And that's when you can use this tool. We just come here, and as before, as we just did for Pablo, I put in my stock at 55. And I said July, didn't I? Yeah, let's go mid-July. And then hit calculate. All right, now based on the Black-Scholes pricing model, we've lost some time premium on the position. The volatility on this put is extremely low, and we've lost about 60 days, a little bit less than 60 days, 55 days. So the stock has increased by 564, but according to the Black-Scholes pricing model, with this low volatility, we'd expect this to drop down to 231. In that case, we'd only have an $87 profit on the Verizon position if the stock hit 55, 60 days or so from now in July series. All right. So that's how you would run those scenarios. And if you think it's going to hit 55 faster, say by June, that's great. With the low volatility, though, I think you're still going to see an unexpected decline. But remember now, you paid 708 for it, and we're 6 points roughly in the money. All right, so the maximum risk that we saw of 144, that's the time value. What's interesting here? Why is it only 251? Because it's at the money. There's no intrinsic value left. This 251 is all time value. A month later, or where were we? 2 months later, it's still at 231. What are you seeing in action here? The ATM Bell Curve that we use for the married put. See, I don't want to buy at the money, even though it's a lower cost. It's going to be a higher risk because that always has the highest time value of any option. We're buying in the money. We're buying over here, so the time value is lower. But as the stock moves from 49.36 to 55, now the 55 strike has the highest time value. It's expected at 231, all extrinsic or time value. And when we bought this position initially, there was only 144. That's the time value, extrinsic value swell of the ATM Bell Curve in action. We actually gained extrinsic value on the put because it went from in the money to at the money. It swelled up by about 90 cents, expected in the theoretical pricing model. That could change with shifts in implied volatility, as we all know. But again, this is what you'd expect. Did you lose on that put? Did it drop from 708 to 231 with the expectation? Did I lose $477 on it? Yes. But I also gained 564 on the stock. Why is it important that this time value swelled and is now higher? Because now that it's at the money, I might be able to sell this one, roll up to a higher strike put to cut this risk down even further if my expectations are made. But Don, that's the one way to do it. You can just plug it into the profit and loss chart, then use the calculate feature down below. A second way to do it, if you're looking at your put on an option chain, you found it on the Verizon position on a search with a search by symbol. Another way you can see what the price of the put option would be at any time between now and expiration if the stock was at 55. Use the more information button, go to calculators, go to Black-Scholes. I just find it easier to do on the chart myself. But I say, okay, I think the stock is going to hit. So here's the deal. The stock's at 49.53. We're looking at our November 55 strike, current volatility, dividend factored in, and the current free interest rate. Not so free anymore. And now I can do the same thing. I say, well, what happens if the stock's trading at $55? And then I click use these hypothetical numbers. This is your time decay curve that we're looking at. I hover over it each day. It's showing me what the expected price of my put option or call option would be at this strike. And then down below, our expected put bid, we can see what the expected price would be each day between now and expiration if the stock was trading at 55 in grid format. So if you're more interested in looking at it in this expectation, in this format, I should say, Don, the Black-Scholes calculator is the way to go. If you just say, hey, what if the stock's at 55 near June expiration, near July expiration, build it in the profit and loss chart, and you can just run it there automatically, and you should be set to go. Okay? So those are the multiple ways that you can do that. Now, going back to the portfolio very quickly, last question for Paul. It's related to married puts, but other positions as well. Paul had purchased a few shares or 100 shares, maybe 200 shares of Peloton at about $14.97. When I was on my coaching session with him, the stock was at $14.05. It's now back up to $14.51. And And Paul had some ideas behind this that it might recover, it has a chance to maybe recover slightly, that he feels it's bottomed. He likes some of the metrics he was seeing with it. He also thinks it might be a target for a potential buyout, which would cause the stock to drop. So Paul's question was, should I be entering this position as a covered call trade, or should I do it as a married put in case volatility in the market stays? Same thing I said earlier for Jerry, same thing I said last week for Edison. Anything new I'm opening now personally, I'm opening as a married put position or as a standard caller, preferably a married put position. Except one thing I did today, and I will share that with you because it was a lot of fun. Didn't get exactly what I wanted out of it, but I'm going to hold it for a little bit. In any case, let's take a look now. Now, my original answer, I'm sorry, I'm going to go to the married puts. Yeah, I'm going to go to the custom spread tool. My original response, no, I'm sorry. My original comment to Paul was that with this type of stock where it has the higher volatility, just like we saw a little bit on USO, but this is much higher than USO. Buying the married put position means we're going to have an increased cost due to the increased inflation. And that also means, as we talked about before, let's just go out. Let's stay with November. Let's see if it was there. It's comparable to the, no, I'm sorry. Let's go back to January. Was it October? I'm sorry. Let me just, okay. I'm sorry. It's not letting me do that. So this tool, the insurance tool, is like, I wanted to use the insurance tool because I'm putting in the cost basis, which is different, but it should be able to give me some results. But let's just forget about that. That's September 2023. I'm sorry. Really sorry, folks. That's why I fouled up. There we go. So what we're looking at here is the strikes that we would normally look at, the 16, the 17, maybe even the 18. Now, 15 is too close. It's at the money, even for my purchase price, but it's still at the money in consideration of the current stock price. But you see here, look at our risks. The locked-in profit means the risk based on our cost basis. 17%, 15%, 13%. So I want to go 20. No, that's 33% in the money. It would have a lower risk of around 10%, but that's 33% in the money. That's a big, big jump. So I said to him, there's two things you got to remember. His question was, should I turn it into a married put and sell calls against it immediately or just sell the calls? And we use the 16 in our example. I might use the 17, but we're going to stick with we're going to go with the 17. Let's go to the profit and loss chart. So based on his cost basis, you can see here the risk is at 15.6%. Now, the one thing I don't want to do is if I bought the 17 or the 18 put, I don't want to sell the 15 or the 16 strike call because that would create a bearish position. And what were his contents? His idea, his trading plan was that he thinks it's going to move back up. He likes some of the metrics, and it might be target for a buyout. So there's two issues there. I don't want to trade a bearish position because if it does fall and I'm wrong, that works out well. But when you sell the put below the cost basis and below the put strike price, you create that bearish structure. Let's say we did sell the 15 call. Let's just go 14 days out, keep it shorter term. Now we're getting great premiums here for this trade. So let's sell the 15. But remember, with the stock at $14.97 and my put price that we would prefer, following the proper techniques of the married put, taking advantage of the ATM Bell Curve and the time value decay, this is more of a bearish position. The risk went up to 21%, not to the downside, to the upside in the direction we thought the stock was going to go. And now you've got a very relatively tight break-even window. Yeah, it's a wide break-even window considering it's a $15, $14, $50 stock. So $16.30 up $1.80. That's a pretty big move for this stock. You know, it's well above 10%. But by selling the call, if it stays below 15, that's great. But if it moves up, and remember, he thought it had a chance to have a sudden move, you've not only capped the upside, but you've given yourself two ways to lose. This forcing the sale of the call, once you've decided to go into the put, puts you in a position that's now trading against yourself. Buying the put is not trading against yourself. That's protecting your investment. Selling the call too soon at too low of a strike price after you've protected the position, in my opinion, is trading against yourself because This is where he thought the stock was going to go. Sure, it's only a 14-day out position, but a lot can happen in 14 days in either direction, as we've seen. But the premiums are strong enough on Peloton because of the implied volatility that even going with that 17 strike, if I go a little bit further out, I can get 60, 70 cents against that risk for the 1750 call, excuse me. And I lowered the risk down to 12.6%. And I still leave the upside open, on the position there in case, not the upside open, but I give myself a wider berth, lower the risk, and I still make a maximum 7.4% in that case the stock is above the strike price there. Compared to just selling the call at 17.5, okay, well, you still take the risk. You get a better break even of 14.27 with the 70 cents premium you could. And remember, the cost basis is 14.97, not 14.51. That's why the break even only dropped to 14.27. Why is that important? There's still a chance for loss to the downside if I'm wrong. And yeah, the stock would need to go away. Could I sell just the at the money call? Of course you could. Right? It's all dependent on your expectations for the stock. Let's go back right to the 15 strike in this case. All right. And there we go. Nice covered call, potential 11.3% return. Lower the break even down to 13.48 for a 20-25 day trade. Not a bad approach for some protection, but after 13.48, there is no more protection. You start to get into the loss. Hey, we'd be getting a loss on that married put too. Don't get me wrong. But it's controlled, and what's gaining as the stock is falling is the put. This call can't make any more than that 149, 150 premium you took in. So as if it keeps falling below the break even, you can't get any more than you got on the call. Can you roll it down? Sure, in those cases. But that's the risk that you get. And that's the risk that you see. Again, preferably I'm opening a married put, but yes, if your target is a more volatile stock, we looked at USO for Jerry earlier, we're looking Peloton now in relation to Paul. In that case, you have to expect that the prices are going to be higher, going to be inflated, and that puts us in that higher risk level. But again, it controls the risk to the downside. If I'm wrong and the stock pulls back and drops down, what did I say the break even was? I'm sorry, 13.48. That's the break even there. It falls to 13.48 on or around June expiration. You know, the put gains some counter against the position at this point, but it's still gaining and it's still holding most of its value. I can manipulate that put if the stock is falling, take the profit off the put and reassess the position. I'm not near that 15.6% loss at all. We're only at a loss of about 110, 115. I'm sorry, 128, it looked like. That was for Paul. That was for the 3 quick questions that came in.